For the last 2 years, the US housing market hasn't just been cold. It's been frozen solid. We've seen a stalemate where buyers couldn't afford to buy and sellers refused to sell. It was the era of the Great Stagnation. But as we head into 2026, the data is signaling a shift. It's not a crash. It's not a boom. It's something we haven't seen in a long time. A return to normal. If you've been sitting on the sidelines waiting for the market to thaw, 2026 might finally be your year. But, and this is a big but, you need to abandon the fantasy of 2021. Welcome back to the channel. Today, we are breaking down the 2026 housing market forecast. We're looking at the new data from Zillow and the National Association of Realtors, analyzing the 6% mortgage reality and explaining why the locked-in effect is finally breaking. Let's dive in. The inventory thaw. Let's start with the biggest problem we've faced: inventory. For years, millions of homeowners have been locked in. They bought or refinanced when rates were 3%. And the idea of selling to buy a new place at 7% was financial suicide. But economists are predicting that 2026 is the year the lock-in breaks. Why? Because you can only put life on hold for so long. People have gotten married, had children, gotten divorced, or changed jobs. The life event pressure has finally built up enough to overpower the fear of high rates. We aren't expecting a flood of inventory, but we are expecting a steady stream. This means for the first time in years, buyers might actually have choices again. You won't be fighting 20 other offers on a dilapidated shack. The desperation era of buying is ending. The 6% normal. Now, let's talk about the elephant in the room: interest rates. If you are waiting for rates to drop back to 3% or even 4% before you buy, you might be waiting forever. The Federal Reserve has made it clear. While we might see small cuts, the era of free money is over. Most major forecasts for 2026 place the 30-year fixed mortgage rate firmly in the 6% range. We need to reframe our mindset. 6% isn't high. Historically, 6% is normal. The 3% rates of 2020 and 2021 were the anomaly, a once-in-a-lifetime emergency measure. 2026 is about acceptance. What does this mean for you? It means your budget strategy has to change. You aren't dating the rate anymore hoping to refinance in 6 months. You are marrying the house and the rate. If you can't afford the monthly payment at 6.5%, you can't afford the house. Price predictions. So if inventory is rising and rates are staying flat, what happens to home prices? This is where the 2026 forecast gets interesting. The experts at Zillow and the NAR are predicting a rise in sales volume, but very modest price growth, around 1.2%. Let's put that 1.2% in perspective. In 2021, we saw double-digit appreciation. 1.2% is basically flat. In fact, if inflation is running at 2.5%, a 1.2% rise in home prices actually means homes are getting cheaper in real terms. This is the soft landing everyone talked about. Sellers will still get a decent price, but they won't get a bidding war. Buyers will pay a lot for the mortgage, but the purchase price won't be running away from them every month. It's a boring market, and honestly, boring is good. The strategy. So how do you play the 2026 market? If you are a first-time buyer, your leverage is returning. Since inventory is sitting on the market longer, you have the power to negotiate again. Instead of offering over asking price, ask the seller for a 2-1 buydown to lower your rate for the first 2 years. Do not waive your inspection. Ask for repairs. The power dynamic is shifting back toward the middle. Summarize. 2026 isn't going to be a magical year where homes become cheap again, but it will be a functional year. The ice is thawing. Transactions are happening. If you've been putting your life on hold waiting for the crash, stop waiting. The 6% normal is here to stay. Run your numbers based on today's reality, not yesterday's fantasy. Thanks for watching. If you found this helpful, hit that like button and subscribe for more economic updates. I'll see you in the next one.